Rekha, would you like to start the webinar?
Sure. Hello again, everyone. Good morning or good evening to you from whichever part of the world you are logging in from. If you were with us last week, welcome back. We are thrilled that you could join us once again. For those who are tuning in for the first time, we are very happy that you could make it to today's webinar series on international estate planning. Today is part 2. We are going to be discussing everything you need to know about having business ties with India. Perhaps you established a business here and are collaborating with an Indian counterpart. Maybe you have an ownership interest in a closely held business back home. Or you could eventually be inheriting a business one day. Whatever the case may be, we hope that today's fact patterns and case studies will arm you with information to help you understand what you should or should not be doing when it comes to business dealings between India and the US. Joining me in today's webinar are 3 very well-regarded panelists, Rahul Ranadive. Let me get to that screen, 1 second. So we have Rahul Ranadive, who is an expert on international and domestic tax from Miami, Florida. He helps high net worth clients and closely held businesses on international and domestic estate and trust planning, private banking, and tax and corporate matters, and basically make sure that they are not running afoul of any US or international tax laws. He has, as someone put it, the real deal when it comes to getting legal tax advice in these areas. Rupal Vora is a tax advocate from Mumbai who is an expert on all things tax as it pertains to the Indian resident and taxpayer. She's probably wondering why she made a trip out to the US, leaving sunny India and entering blizzard-like conditions in the US. But nevertheless, Rupal, she will help us understand taxation from the Indian standpoint and what business owners need to be aware of when managing and operating a business in India and what it takes to be tax compliant there. Vinay Navani, a shareholder at Wilkin Guttenplan, which is a well-known and prestigious accounting firm in New Jersey. Vinay assists clients with things like business sales, restructuring, retirement plans, charitable giving, but his expertise is in foreign tax and compliance-related matters. I personally think that his skill set is in fixing the messes that clients seem to have a knack of getting themselves into, which, as you can probably guess, is not an easy task. As for me, my name is Rekha Rao. I am the principal of Rao Legal Group. I have a trust and estates firm in Princeton, New Jersey, and I help clients with their estate planning by drafting their wills and trusts and essentially helping them establish a proper succession plan for their assets in case of incapacity or death. I want to take this time to thank Vinay and the folks over at Wilkin Guttenplan who are helping host today's webinar. A big shout out to all of them. Now on to a few housekeeping issues. Participants have been muted, but feel free to ask any questions by typing your questions in the question pane. We will try to address all of those questions during the Q&A session at the end of today's program. If your specific question is not answered today, feel free to email us and we'll try to answer them after the program. Our email addresses are going to be shown at the screen towards the end of the program. And as always, the recording for both parts 1 and 2 of the webinar series will be uploaded onto the website as you see on your screen. So now on to our fact patterns. Do you remember Ravi and Sujata from last week? For those of you who were not with us during part 1, Ravi and Sujata moved back to India in the 1990s after living in the US for several years. And what you did not hear in part 1 is that Ravi also has 2 very successful IT companies that he has established in India. So my first question is to Rupal. Rupal, what should Ravi be thinking of in terms of being tax compliant in India?
Here, Rekha. For being tax compliant, one has to file an income tax return. So Ravi needs to keep in mind that the tax year in India is from 1st April to 31st March, unlike US. Also, he needs to get a permanent account number for both his private limited companies. And then the return of income for both the private limited companies should be filed by the 30th of September. If any of the company has any transfer pricing issues involved, then a transfer pricing report needs to be filed. And in that case, the date for filing of the return is 30th of November. Also, if the gross receipts or turnover of his companies is over 10 million rupees, then there is a statutory requirement to get tax audit done and a tax audit report to be filed. Besides this, he'll have to pay advance tax on 15th of June, September, December, and March. Also, being a private limited company, if he decides to distribute dividend in any of his companies, then they'll have to pay dividend distribution tax. Luckily for him, from last year, there is no wealth tax, so he doesn't have to file any wealth tax returns. And besides these compliances under direct taxes, he'll also have to have certain compliances under company law and indirect taxes to be taken care of.
Great. Awesome. So Vinay, I'm going to take this back to you now. From the U.S. perspective, do Ravi and Sujatha need to be thinking of anything?
Sure. So for those that weren't on last week's webinar, the primary guiding principle here is that as a U.S. citizen and a U.S. green card holder, Ravi and Sujatha are subject to tax on their worldwide income. So you really have to forget about the concept of borders and countries when you're thinking about U.S. taxation. So it's really as if Ravi owns a business entity similar to as if it had been in the U.S. that happens to be in India. So from the way this question has been set up, the IT consulting firm, a private limited, generally will be respected as a corporation for U.S. tax purposes. So as such, unless the company, with one exception I'm going to talk about in a second, unless the company is making dividend distributions to Ravi, he will not be taxed on the earnings of that company. The big exception is something which is a little bit complicated, known as Subpart F income. And the trap there is if the Indian private limited company is doing a lot of related party transactions with a U.S. entity and primarily doing work outside of India, you can have a possibility where income could be subject to Ravi on his personal tax return, even though no cash has been distributed. But we're going to assume that that's not applicable here. So once assuming that there's no dividends being paid, and of course, if the private limited pays salary to Ravi, Ravi has to include that in his income as if he got a salary from any employer. But in terms of the disclosure, there's a Form 5471. And think of a Form 5471 like a corporate tax return. You're going to be disclosing the full financial details of the Indian IT company, profit and loss, balance sheet, things like that, and showing all the details, who are the officers, who are the owners, and that will be attached to Ravi's U.S. tax return. And the penalties for not filing that form are pretty steep, so it's very important that that doesn't get overlooked. Rupal mentioned that in India the tax year is March 31st. For U.S. purposes, since the company is owned by an individual who has a calendar year, as we do in the U.S., we'd have to convert the financial information to a calendar year basis, which can sometimes just require some upfront planning. We also spoke last week about the importance of the FinCEN Form 114 or the FBAR to disclose foreign accounts. So even if Ravi didn't have any personal accounts, which he probably does because he's living in Mumbai, but even if he didn't, the IT companies have business accounts, which I'm sure will have values over $10,000, which is the threshold for filing the FBAR. And because Ravi is owns more than 50% of the shares, he has to report on his FBAR the business bank accounts of the IT consulting companies. So that's very important. And then lastly, there's another form that has to be attached to Ravi's personal return, Form 8938, which discloses all foreign financial assets. And we just need to indicate that he has these two companies and that he's already filed Form 5471 so that, again, he avoids the pretty harsh penalties for not filing a Form 8938.
That's great. Vinay, you mentioned a 50% or more threshold of ownership. So is there a certain percentage below which he wouldn't have to do any reporting?
So the 50% I just mentioned was with respect to the FBAR. But in terms of the Form 5471, there's actually a host of different, the form itself is very comprehensive. And based on your ownership and whether you acquired shares or disposed of shares, you might have to fill out different parts of the form. So, and especially if you're an officer, I think it's a pretty safe bet you're almost always going to be filling out some portion of the 5471. You may not be disclosing the full profit and loss or balance sheet, but you'll be filing something. And if you do meet the exception that you're out of that requirement, then you flip over to that other form I mentioned, Form 8938, and you'll be disclosing some information about the private limiteds on that form. So in almost any event, you're going to be doing some level of disclosure.
Got it. Okay, Rupal, back to you. Since Ravi is, as you can see, significantly doing very well, and the companies are, generating a lot of income, is there anything that he can take advantage of in India to help, him and his family with the significant tax that they have to pay every year?
Sure, Rekha. What would really help is having a look at his P&L and balance sheet and the nature of business, where the business is located, etc., to be able to give a very detailed, specific advice as per how he can go about reducing his tax liability. However, generally speaking, I can say that normally what happens when individuals like Ravi start a private limited company, in initial stages, since there isn't enough income that's being generated in the company, people tend to take very nominal or token salary. Also, the director fees for attending the board meetings, etc., is a very token or a nominal amount. So now, when they've started earning income, now is the time that Ravi needs to start paying salaries to himself and his employees as per what is the norm in the industry and based on the qualifications and the work done by people. Similarly, the director's fees also can now be proper director fees, not just a token fee. Similarly, often we see that when these kind of companies are started, Ravi may have had an office premises where he started this company. So now that the company started doing well, Ravi can think about entering into a rental agreement with his company, whereby the company is paying rent to him for using the office premises. So all these expenses, if he's not already taking care of them, then all these expenses can go about reducing his income. Besides this, he can also think of taking accelerated depreciation on certain kinds of equipments which he may employ in his business, like if they are energy saving, pollution controlling, and environment friendly equipments and appliances, then all those would go on to reduce his income because the depreciation rate is pretty high.
Got it. And Vinay, you spoke about some traps that Ravi and Sujatha need to look out for. Can you elaborate a little bit on that?
Sure. So the trap is something known as Subpart F income, which applies to U.S. corporations that are more than 50% owned by U.S. people, or otherwise known as a controlled foreign corporation. So an example would be if the Indian company gets a contract to do some services in Singapore, on site at a client site in Singapore, and the Indian company will acquire those consultants on a secondment, let's say, from a related U.S. company. So then you have three different jurisdictions. You have a business taking place outside of India, and it's related with the transaction with a U.S. affiliate. So that would be an example of Subpart F income. So it doesn't happen every day in the IT services industry, but in other types of businesses, it can happen, especially with manufacturing, distributorships, things like that. So it's just something you have to really watch out for, because otherwise then you're just paying tax on income, basically on a phantom income in the U.S., even when the cash has not been remitted back to the U.S. shareholder.
Got it. Rahul, from the planning perspective, is there anything Ravi and Sujatha need to be thinking about for the purposes of U.S. estate tax?
Yes, definitely. And income tax as well. So let's start with income tax. So when we think about planning, we're always viewing planning in terms of avoiding what you don't like, trying to avoid bad consequences. So let's assume that they don't have the related party issue that Vinay talked about, and there's no Subpart F problem with phantom income. But they still may not enjoy having to do that 5471 every year, and paying a lot of accounting fees in doing that. It's a very comprehensive form. So in that case, they may want to look into divesting enough of this ownership of the company to bring themselves down below the threshold levels, which would help them avoid the 5471. So the two options they have there are selling a portion of the business, and then you would want to do some planning on that to minimize the incidence of capital gains and making sure you get a foreign tax credit for that capital gains. Or they can consider making gifts of the stock to various family members or certain high-level employees that they want to share the equity with. And then they would have to consider gift tax issues and how to minimize that. Moving to the estate tax planning issue, we'll recall from last week's session that Ravi and Sujata currently have a combined net wealth of approximately 4-point-something million dollars. Now, assuming that that is held jointly so that it's equally split between the two, they are both well below the current exemption amount of 5.45 million per person. But we don't know the value of this business, and that may push them over. So again, to do estate planning issues, they would want to, if they want to get underneath the thresholds, if they're above it, they would look into some type of a gift transaction, because a sale transaction won't help them, right? If they sell the stock, they're just going to get cash for that. It doesn't change their net wealth. In order to bring themselves below the threshold amount, they would have to do some type of a gift transaction.
That brings up a good point, because if you're trying to gift businesses, could they take advantage of some discounting, further discounting, to make that gift, get more bang for your buck?
Yes, certainly. Whenever you're giving away a minority interest in a company, you want to take a look at how much you can utilize what's called valuation discounts. Someone who has 10% of a company has very little control over the company through their vote, and there may be restrictions through a shareholder agreement which prevents them from freely selling the shares. And so, all of those items you would want to look at to say that, well, the value of the gift isn't the value of the company divided by the 10% stock I'm giving away. It's really the value of the company divided by the 10% stock, then some 20 or 30 or 35% discount off of that number to take into account that you have a minority interest, you may have blockages on transferability, and et cetera. So that's definitely something that would go into the analysis.
Great. So we will now move on to our second case study, which is we've got a young man who's come to the U.S., leaving his family and a family business behind. And as you can see here, he has been made a 10% owner of a textile company that his dad owns and operates. And during that time, his father also set up a PPF, a public provident fund. So Rupal, my first question is to you. These PPFs are pretty common in India, correct, as a way to reduce their income tax liability? And also, are they set up by individuals or by companies?
Yes, Rekha, it's very true. PPF is a very popular savings scheme in India, and it's for individuals and resident individuals. So a PIO or NRI cannot open a PPF account. However, in Hardeep's case, the PPF account was opened when he was in India, when he was a resident Indian, and subsequently he has become a non-resident Indian. So a PPF account has an initial maturity of 15 years. So say after the initial 5 years of being a resident Indian, Hardeep became a non-resident Indian, then he can still continue to contribute to his PPF account till it matures. He couldn't have opened the PPF account as an NRI, but since it was opened while he was a resident Indian, he can continue to contribute to it. The contribution can come either as a remittance from US or from his NRE and NRO accounts. But once the account reaches its maturity, a resident Indian has the option of renewing it every 5 years after the initial 15 years of maturity. But since Hardeep has now become a non-resident Indian, at the 15-year maturity, he will not be able to renew it. He will have to close his account. Often it happens that people forget about it and don't close their account. In that case, it automatically gets extended for 5 years, but they cannot contribute to it anymore. So in Hardeep's case, now that he'll have to close the account, what he'll have to do is withdraw the amount from the PPF account. It will be closed. Deposit this into his NRO account. Now what is interesting is the tax benefits he's getting. Now every year a resident Indian is allowed to deposit 150,000 rupees. It can be less, but the maximum threshold limit is 150,000 rupees into the PPF account. This amount which is deposited into the PPF account is available as a deduction against the total income. Moreover, the PPF account enjoys interest of 8% currently, and that interest is tax-free. And also at the time when it matures and the amounts are withdrawn, the amount withdrawn is also tax-free. So for Hardeep, there is going to be no tax liability in India. However, he needs to keep in mind that PPF interest will be taxable in the US. Now the amounts that are lying in his NRO account, he has an option to remit them to US if he wants, in which case he'll have to satisfy the bank as to the source of the income and that he's tax compliant and FEMA compliant. And once all that is done, the bank will allow him to remit the funds within the limit of $1 million a year. So this is what he can do with his PPF account on maturity. Till maturity, he'll have to he won't be able to close it, and he can contribute and take benefit of it. But on maturity, he'll have to close it.
Got it. Vinay, so what should Hardeep do in terms of disclosing all of this in the U.S.? Because it does sound like it's a very Indian-specific benefit that he's getting. And also, can you speak to whether it matters, whether it's post-maturity or pre-maturity?
Sure. So the PPF obviously has special tax status in India. In the U.S., it doesn't. So in the U.S., you really have to think of that like any other type of bank or CD or whatever type of similar type of account. So as an account, it would be reported on the FinCEN Form 114, the FBAR, with the highest balance. And if you are required to file the Form 8938 because you meet the threshold, because you have the required amount of foreign assets, then you would be disclosing the PPF on the Form 8938 as well. And to the extent that the Public Provident Fund paid interest or accrued interest during the calendar year, you would be showing that interest income on your U.S. tax return because, again, the IRS does not give that PPF fund special status in the same way a 401k or an IRA would be. Now, Rupal mentioned the maturity and the maturity threshold. So, I know some people who will take the position that before the maturity of the PPF, they cannot access the funds, so therefore it should not be subject to U.S. taxation. I'm not sure if I agree with that or not, but in all the cases I've been involved with, the amount of interest income or earnings from the PPF has been a relatively small amount, and it's better to take the conservative position, in my opinion, of just reporting the income anyway. So it is an asset that gets overlooked quite a bit, and it's important to be sure to report that.
Right, right. We spoke about the PPF, but Vinay, Hardeep still has a 10% ownership in the textile company. So what should he be thinking about with respect to that?
Yeah, so he's got a reporting obligation. If he is not so a couple of things. If he only got 10%, in the year that he received his 10%, and ultimately in the year that he disposes of his 10% that we may talk about later, he has an enhanced reporting on the Form 5471 because there is additional reporting in the year you acquire or dispose of a company. If he's not an officer of the company, he may, officer or director, he may escape having to do any 547 reporting. It's not 100% clear based on our facts. But if he does, then he is going to be reflecting the value of the 10% interest on that Form 8938, assuming he's required to file. And especially in a situation like this where it's a privately held company where the value may not be really well known, it's probably better to err on the high side and list the value there on the high side and be on the 8938 than take the position that the value is below the filing threshold if it's in any way gray.
Got it. Got it. So let's talk about what if he wants out. What if he just tells his dad that he doesn't want any interest in this company anymore, and just the ramifications of what would happen if he just gave the interest away or if he actually got something in return. So Rupal, I am going to start with you. Could you just speak to that a little bit?
Sure, Rekha. Hardeep can liquidate his 10% holding either by giving it as a gift to someone or by selling the shares. If he were to give it as a gift, and if the gift is given to a relative, then there will be no gift tax in the hands of the recipient. However, if the person who's receiving the gift is not a relative as defined under Section 56 of the Indian Income Tax Act, then the recipient will have to pay tax on the gift received, and the tax will be computed on the fair market value of those shares. Now, if he decides to sell the shares instead, then he'll have to pay capital gains tax on it, and the capital gains tax will be computed by considering the cost and the sale, and you compute the gains thereon. For the cost, it will depend upon how these shares were acquired by Hardeep. If they were a gift to him from his father, then in that case the cost would be the cost to the father. But if he had acquired it out of his own funds, then the cost would be the actual amount paid by him for the acquisition of those shares. Now, when we come to the selling price, there has been a latest amendment in the recent budget, it's in the Finance Act. So now if he goes to sell his shares, say for example he's selling his shares at 15 rupees to somebody, but the fair market value is say 20 rupees, then now in view of this new amendment, it is 20 rupees which will be taken as the sale consideration, because it's very clearly stated that valuation of unquoted shares will have to be the fair market value, which is to be determined in the prescribed manner. So if 20 rupees is the fair market value which is determined, then that will become the sale consideration, despite Hardeep having received only 15 rupees for it. So based on this sale consideration cost, the capital gains will be computed and the tax thereon will be computed. However, he can invest in certain specified assets and not pay capital gains tax. But again, while doing that, he'll have to bear in mind about the US tax consequences, which I'm sure Vinay will be touching upon. And he being NRI, he will also have certain FEMA reporting requirements, which he'll have to comply with.
Got it. So Vinay, let's talk about the U.S. side then. Can you add what what would happen if Hardeep wanted to liquidate his interest in India?
Sure. So there's actually a lot of similarities in this transaction on the U.S. side and on the Indian side. So if Hardeep plans to sell the shares, first we have to really understand two things: what's the selling price and what's the cost basis. So the cost basis will be similar to the Indian methodology. If Hardeep received it as a gift from his father, Hardeep's cost basis is generally considered to be his father's cost basis. And if Hardeep actually paid for it, his cost basis will be what he actually paid for the shares. So that's his cost basis. Now, because this is a related party transaction between father and son, we do need to make sure that it is considered to be at arm's length. So we want to make sure that if the selling price is 20 rupees per share, that we have a valuation or some objective means to support that valuation. And if that's what it is, if the selling price is 20 rupees per share, and just let's say his cost basis is 2 rupees per share, we have an 18 rupee per share gain, which will be reflected on Hardeep's U.S. tax return on Schedule D as a capital gain, similar to any other transaction. Now, let's say that it turns out that the valuation of the textile company is only 15 rupees per share. So we have a 5 rupee per share gift element because his dad paid him 5 rupees more than the shares were worth. Then we look at the aggregate value of that gift, And in the U.S., to receive a gift is not a taxable event, but if that value of the gift, along with other gifts received during the year from foreign sources, exceeds $100,000, as we discussed last week, Hardeep will have to file a Form 3520 to disclose that gift on his U.S. tax return. In addition, we spoke about the Form 5471, and even though Hardeep only owns 10%, in that year, he fills a different part of the form to reflect his disposition of the shares, and there'll be some enhanced reporting required on that. Rupal mentioned that there's various schemes in India to minimize or avoid the Indian tax on the sale, such as reinvestment in certain government bonds, I think, and things like that. None of that applies in the U.S. So you really have to make sure that if you're going to take advantage of a reinvestment in India, that you have enough cash flow to pay the U.S. tax associated with the sale of the shares. And I think that's most of the big picture issues that I see.
Got it. And then Rahul, any thoughts from your end?
No, I think Vinay covered it mostly well. I mean, the big question is a lot of times there's confusion on whether sale of foreign stock will qualify for a U.S. tax credit. The foreign tax that you pay on the sale of that stock. Generally, the rule is you get a foreign tax credit only on tax paid on foreign source income. Now, the problem is that the U.S. treats capital gains sourced based on the residence of the seller. So you have a U.S. person selling foreign stock. India is going to treat that as Indian source income because it's Indian stock. U.S. will treat it as U.S. source income because it's the seller is in the U.S. resident. So in those situations, you have to look to first whether you have a treaty that will resource that income as foreign source, which would allow you to take the foreign tax credit. Unfortunately, the U.S.-India treaty doesn't help here. Article 13 on capital gains in the U.S.-India treaty provides that each country gets to treat and tax capital gains under its domestic law. But then we have a statutory provision, Section 865H, which does come in to save our U.S. taxpayer and will resource what is ordinarily U.S. source income as foreign source income solely for purposes of the foreign tax credit. So, here, luckily, if Hardeep does sell the stock, even though it's technically U.S. source, 865H will resource it as foreign source, and now he can take the foreign tax credit for the Indian taxes paid.
Thank you, Rahul. That just sounds like, to me, if someone's dealing with an issue like this, they're better off consulting you rather than trying to do stuff, arbitrarily without any knowledge. All right. Sorry, go ahead.
I would not recommend going to YouTube to DIY this.
Good point. So we're tweaking the facts a little bit. We've got Hardeep, who I guess he's got entrepreneurial spirit in his genes. He wants to start a company here, and he wants to take advantage of cheap labor in India. So he convinces his dad to set up a company in India. His U.S. company is called TTS, and he wants dad to set up MSS, which will fulfill all the projects that TTS brings to it. One good thing about what Hardeep and his buddies are doing is they're really trying to make sure they do everything by the book. So Vinay, in this case, what are Hardeep's reporting requirements as a result of his association with MSS?
So this is a gray area because based on the way we've set up the facts, they're really unrelated, meaning that Hardeep does not own the Indian company, but obviously it's Hardeep's father, so it is a friendly relationship. If the ownership, the different ownership is respected, then a lot of the forms that we spoke about with related parties, the Form 5471 would not apply, but I still think it's critically important that everything be done at arm's length and that we utilize what we call transfer pricing. And transfer pricing really is just saying that if there is a relationship between two companies, that we're dealing with them on the same basis as we would if we were dealing with somebody who had no relationship at all. So if I'm looking for if I'm hiring NSS to give me a Java programmer and I'm paying them $40 an hour, but I could go to Wipro and find the same Java programmer for $20 an hour, that's going to be considered abusive because the IRS is going to say you're using this relationship with your father to drain profits out of the U.S., and that will be subject to scrutiny and penalties and bad things. So that's really the critical thing. Anytime you have related party transactions is to make sure that your transfer pricing is done at arm's length.
Got it. And then Rupal, from the Indian standpoint, what should he be thinking?
From the Indian standpoint, even though, as Vinay pointed out, that Hardeep does not own the Indian company, I'm personally of the opinion that the way the phrase associate enterprise is defined under the Income Tax Act and the way international transactions is defined under the Income Tax Act, both these companies, Indian as well as the American companies, will be considered as associated enterprise of each other, and hence the transfer pricing provisions will apply. So they will have to file a transfer pricing report, and the transfer pricing officer will look into these transactions that are taking place between the two companies and try to determine the arm's length price. Though the fact pattern does say that everything is at arm's length, that's not enough. It's the transfer pricing officer who has to be satisfied that the dealings are at arm's length. If, however, he feels that they are not, then he's likely to make additions to the income of the Indian company, and then the Indian company will have to litigate. So what they can do is to avoid this litigation, which invariably happens, they can think of entering into an advanced pricing agreement with CBDT. They are called as APAs in short. So in this, what happens is that both the tax department and the taxpayer agree on an arm's length price, or agree on the method at which the arm's length price is going to be computed. And then that agreement is binding on both the parties for a period of 5 years. So this way, you in advance decide the arm's length price and avoid litigation at a later stage.
Got it. So Rahul, can you speak to how the IRS views these international businesses? What red flags should they potentially be looking for?
Well, in terms of red flags, anytime you have related party transactions, as we've discussed with transfer pricing, making sure you have arm's length transactions doesn't just mean you going out and making a survey of what you think your competitors would charge and then making up the prices. It means actually going out and hiring a transfer pricing specialist and having a full transfer pricing study done that you can keep in your file, kind of as a shield in case you are audited. So then that way, if you are audited for transfer pricing issues, you can right away pull out the study and say, look, I paid a lot of money for this study. These professionals examined the marketplace. They used 3 or 4 different of the existing methodologies to determine what the comparable uncontrolled price or all the different standards that apply in transfer pricing. And so it is really worth the investment in making sure you do it right, follow all the steps, have your documentation in place, because that will save you a lot of headaches down the road if you are audited.
Got it. And I'll stay with you because actually, let me just take it to Rupal. Rupal, if Hardeep is looking at this as an inheritance, let's just say he's going to be getting this company from Dad upon Dad's death, what should he be thinking about in terms of probate and succession?
Depending upon where Hardeep lives, probate is mandatory in certain cities, not all. And a lot of times, though probate is not mandatory, people do opt to get a probate so that there is a very clear title. However, if it's only the shares in private limited companies that Hardeep is likely to inherit, then probate is not really necessary because it's quite simple. It can be even transferred by mere nomination. So if Hardeep's father makes a will and also on the shares makes Hardeep the nominee, then the transition of shares from Mandeep to Hardeep becomes pretty smooth on Mandeep's demise. So whether he goes in for probate or not will mainly depend upon what other assets he's inheriting, where he's situated, and whether he is anticipating any kind of dispute as far as the will is concerned down the line. Then in all those scenarios, it's always advisable to get a probate so you get a clear title from the court.
Got it. So let's just say the business was the only asset. Would he need a separate will in India, or do you think his US will would be adequate?
We're talking about Hardeep inheriting. So it'll be Mandeep's will, and Mandeep is a resident Indian. So in that case, the will would be in India itself. But say, for example, we were to talk of Hardeep's will, and Hardeep being a non-resident Indian and having a lot of assets in US, then he would make a US will. And if he has a very few, maybe just some shareholding in India, he can incorporate that in his US will. He doesn't have to have a separate will. It's only in instances where there are substantial assets in India, immovable property is involved. And in that case, we advise to have a separate will in India. And even in instances where we feel that there's likely to be litigation or the will is likely to be contested, there again, then we suggest not only that there be a separate will in India, but that will should also be registered.
Got it. And Rahul, back to you in terms of succession planning for Hardeep, for basically inheriting the business after Mandeep. Is there anything that he should be thinking about and planning now?
Yes, definitely. So let's first look at it from an income tax point of view. Again, we're returning to the questions of CFC status and Subpart F income, and whether that's the status that they want or not. When he does inherit the shares from his dad, the first thing he's going to want to look at is whether it makes sense to do what's called a check the box election, and that would be whether he is able to make an election for U.S. purposes to treat the Indian entity as disregarded. Now, unfortunately, private limited companies in India are per se corporations and not eligible to check the box. So in this particular situation, it won't help him. But let's say the company was in a different country other than India, and he can make the check the box. If you make the check, you have a 30-day window in which to make that check the box election and get to what's called disregarded entity status, in which case the U.S. treats it, it's a tax fiction, it treats it as if the entity doesn't exist and as if Hardeep owned all of the underlying assets directly, and he would report all of the activity of the entity on his personal tax return. Moving then to estate planning questions. Again, we need to know a little bit more information about Hardeep's net wealth, whether whether he's above or below the 5.45 million threshold, what's the value of this company, is it pushing him over the threshold, and then also we would want to look at probate issues, as Rupal mentioned. When he dies, if he owns the stock of the Indian company, whether he can transfer it by nominee, as she mentioned, or whether he'll need an actual will to be probated in India. And then you have to then look at the question of whether it makes sense to have two separate wills, kind of one master will in his home jurisdiction in whichever state in the U.S. he resides in, as well as an Indian will that integrates with the U.S. will. And you want to make sure you avoid a situation where if it's poorly drafted, one will may cancel out the other. So they have to be very integrated. or if he just has one will from his primary jurisdiction, his U.S. state, which is then submitted as ancillary probate in India if he needs to do a probate for the stock. If he can avoid it through the nominee system, then that's great. That's even better.
Right, good points. Vinay, based on what Rupal and Rahul have said, is there anything that you'd like to add?
Yeah, and it's more of a bigger picture issue, not so much directly tied to this, but really kind of the driving force behind both of these webinars is that so many people come to me when they've been in the U.S. for many years, there's no intentions of going back, their kids have been raised in the U.S., and really the driver to regularizing a lot of income or assets which may not have been properly reported in the past is how am I going to plan when I pass away so that my kids get the benefit of this wealth? Because it's going to be much more difficult for the kids to go through and navigate the Indian system to get control of these assets. So this is a perfect example that Hardeep should really take the steps to make the IT company a direct subsidiary or gain direct ownership of the Indian company if it's really acting as a unified package to customers, because this company could, develop some traction. A company may want to come buy them, and they want to buy the whole package, the U.S. With India as the service provider. And when you have this different ownership, it just becomes much more difficult to do that, either in an exit or upon the death of Hardeep to give the value to Hardeep's kids. So just many reasons why, having these kind of unwritten understandings are not great solutions.
Right. So, well, that actually brings us to our last case study for the series. This is, talking about implied arrangements. We've got an Indian resident who's trying to expand his business in the U.S., and he convinces a family member to create a company in the U.S., and there's sort of this understanding between the two of them that the business is really owned by Chirag, who's the Indian resident. So, Vinay, back to you. Do you see a lot of these types of business arrangements which sort of look like, implied business arrangements between friends and family?
Unfortunately, I do. And I think the reason is that when people are starting businesses, their focus is on making the business grow and worrying about the paperwork later. And I don't think it's, done out of, for the most part, done out of trying to hide or avoid tax. It's just, let's start tomorrow, and I've got my relative that lives in Texas, and he's willing to form the company under his name, because you can go online and form the company if you have a U.S. owner much easier than you can if the owner is going to be a foreign entity. So let's just have that person form it, and let's just hit the ground running, and then we'll worry about cleaning it up later. And as I said before, I've seen situations where you have other investors coming in and start to do due diligence, or somebody wants to buy the company, or there's litigation, or maybe there's family issues with Raj, and it tangles up the assets and the ownership, and it makes life much more difficult. So unfortunately, I do see this.
Right. So can you discuss what types of entities could be proper here, proper legal structures for businesses like this?
Yeah, usually in this kind of a situation, what I would typically see is the Indian Private Limited, CS Associates, would form a corporate subsidiary, and they would wholly own that corporate subsidiary. And then you would still abide by all the transfer pricing rules that we've spoken about earlier, but that would be the ownership. Now, in the U.S., you can operate as a branch. CS Associates Private Limited could just open a branch office in the U.S., and I see people doing that for kind of the similar reasons. I think it's easier to do that from an Indian perspective. From a U.S. perspective, I really like to discourage operating into the U.S. as a branch, because the U.S. has something called the branch profits tax, which is really designed to put a branch on the same footing as a U.S. corporation. But at least with a U.S. corporation, you have a separate set of books, and you know the transactions that involve the U.S. corporation. So there's a lot of clarity to what's the profit and loss and taxable income of the U.S. corporation. When you have a branch, that clarity isn't there, and you can get some very unexpected results when you're calculating income. So we do try to avoid branches. The other thing I'll notice is, in our example, Raj lives in Dallas, and because he's in Dallas, I don't know if I said in the example, they formed a Texas corporation. So Texas may or may not be the right place you want to be in. So you really have to give some thought as to where your business in the U.S. is going to be, and consider what's the right state to incorporate it.
Got it. Rupal, I know from the India side, you have spoken both last week and this week about restrictions of transfers of money out of India, but can you elaborate that a little further based on this example?
Sure, Rekha. Now, in the liberalized scheme that the RBI has come out with, every individual, including a minor, is allowed to remit $250,000 a year. So if Raj wants, he can expand his business by remitting $250,000 to US and investing in US. If he needs more funds, he can use his family members, who can each of them remit about $250,000. And then he can incorporate a corporation in the US and expand his business. Alternatively, as suggested by Vinay, if they feel that no, it's more convenient for somebody in the US who's a US citizen to have a corporation, and then the funds are lacking, then Chirag can gift to Raj up to $250,000 a year, and then Raj can incorporate and take it from there. But here, Raj will have to pay tax in India on the gifts received by him from Chirag, because Raj, being wife's cousin, would not fall under the definition of relative given under Section 56 of the Income Tax Act. If they want to avoid this, the other way they can go about is, again, as Vinay suggested, Chirag's private limited company in India can open a wholly owned subsidiary in the US. So that private limited company will be allowed 400% of its net worth, as per the last audited balance sheet, to be invested in the US. So these are the various options that are available to Chirag. Either he can gift to Raj and then Raj starts a company there, or he himself, in his individual capacity, remits the funds and starts a corporation in US, or his private limited company opens a wholly owned subsidiary company in the US.
Got it. And it probably is a good idea now to just kind of explain that difference. You mentioned the $250,000 per year. Rahul, this is very different from our annual exclusion of $14,000 per year, correct? So could you just explain what the difference is from the $250,000 versus the $14,000?
Sure. Well, I mean, they apply to two different things, right? And India is concerned about losing hard currency, so they don't want dollars leaving the country, and so they put that limit on how much hard currency a Indian citizen can remit out of the country. That's the $250,000. The $14,000 annual exclusion is something that applies for U.S. gift tax purposes. Every individual is allowed to make gifts up to $14,000 per person per year without being subject to gift tax. So a U.S. person making a gift of any type of gift, because U.S. people are subject to gift tax on their assets located throughout the world, would be able to gift up to $14,000, and if they gift split and join with their wife or their husband, their spouse, it would be $28,000. And for a non-U.S. person who is subject to gift tax only on U.S. situs assets, which basically means cash located in the U.S., and there's some debate about that, but basically cash, and also real estate located in the U.S., they would be allowed a $14,000 exclusion amount that is not subject to gift tax.
Right, and that's per beneficiary per year, right?
Correct,
so,
per person per year, right.
Per person, yeah. All right, and then going back to Vinay, Vinay, if I flip the facts around a little bit and say, what if we have a U.S. citizen who set up a business in the U.S., but then relies on projects done by people in India, and let's say now this business is run out of some friend's home and people just come to the home and work there and payroll is made in cash, so there's no real corporate structure. Can you speak a little bit to how the U.S. treats those types of arrangements?
Yeah, it's a mess. You know, getting back to what I said before about how in the long run, as the U.S. business grows, they're going to want to regularize that. It just creates lots of problems to how you do that when, A, you don't have a direct legal connection, and B, it sounds like the operations of that Indian entity are not really being done according to U.S. standards with a clear trail. So there's really no great answer other than the fact that it may be a convenient solution for the time being, but in the long run, it's going to it may hinder the growth of the U.S. company.
Got it. So just do it right from the get-go.
Exactly.
All right. So this actually now brings us to the end of our program. We are going to start the Q&A session. I realize we're running a little bit behind schedule. So for those of you who need to sign off, just please know that the webinar is actually being recorded. And as we said, that we will have it uploaded, and it should be on. Let's see here. Sorry. Well, it's on the website of www.wgcpas.com. So now let's start with the Q&A session. We are going to spend a few minutes talking about the questions that came through last week. We hadn't had time to complete all of them. So we're going to start with the first question. And Rahul, this question is for you. We had grandparents that I think there was a question that was posed. Grandparents wanted to give gift funds into 529 plans set up for the grandkids here in the U.S. So the question was, how should it show up on the U.S. tax returns, and is there any limits to the funds transfer? And I know you said you were going to do some research to get back to us on that. So do you have an answer for that?
Yeah, definitely. And first, let me just say that I wanted to thank our guest, our attendee who asked this question. Anytime I get a question that forces me to do research and learn more is very appreciated. So if I recall correctly, the grandparents in India here are making gifts. Ideally, we would want to start with the premise that they're going to make the gift from cash located in India, so we don't have any gift tax issues. But let's just say that they do make a gift of cash sitting in a bank account in the U.S., so we do have gift tax issues. So with a 529 plan, the gift is treated as being made when the cash goes into the 529 plan, not later on down the road when it comes out of the 529 plan to pay for qualified expenses. And in terms of the exclusion amounts and the total maximum limits, you have to distinguish between two different 529 plans. You have prepaid tuition plans and college savings plans. Now, prepaid tuition plans have a maximum contribution limit of, for most states, $300,000. Some states are a little bit more. In contrast, college savings plans have a maximum value limit, meaning if you put $250,000 in and over time it grows to $300,000, you can no longer put any money in. Whereas with the prepaid tuition plans, you can put up to $300,000 and it can continue to grow. And if you have put in $250,000 and it grows over $300,000, you still have a $50,000 amount to put in. So those are the overall limits on the plans. But on a one-time gift, let's say the grandparents want to make a large contribution in, then, and again, assuming it's unfortunately a gift from U.S. side as cash that we have to take into account U.S. gift tax, now we have to look at that $14,000 limit, not limit, but the annual exclusion amount. And anything above that exclusion amount would potentially be subject to gift tax. Now, there's a one-time exception for the 529 plans where you are allowed to contribute as much as $70,000 upon inception, and that $70,000, or if it's less, it's spread out over 5 years. So let's say you deposited $50,000 into the account, you would be treated as making a $10,000 contribution for this year and each of the next 4 years. And so you would still have $4,000 of unused exclusion amount for the future years. Now, if the grandparents wanted to make, let's say, a gift of $250,000, then they would utilize that $70,000 exemption. That would be excluded from gift tax. But anything above that $70,000 would be subject to gift tax. And they would then look to see whether they have any lifetime exemption amount, which for gift tax purposes is $1 million, not the $5.45 million. And if they don't have any gift tax exclusion amount available, they would then have to pay gift tax on that.
Got it. Thank you, Rahul. Rupal, there were some questions that came through, and the next two will be directed to you. One question was, do you do property litigation? And if so, are you available to do that kind of work in India?
It would depend upon what kind of property litigation it is. If it's tax related, yes, definitely. But if it is not tax related, then I don't do it. But I can definitely recommend a few people who would be able to help out.
Perfect. Also, the next question is, are there any do's and don'ts before, during, and after a sale of property?
Yeah, plenty. It's a rather general question. Yes. Well, to begin with, if you want to sell your property, then the first thing you'll have to go get a broker, because that way it makes things easier, especially if you're sitting in US. And nowadays you have a lot of these international companies, so they would be a good way to begin with, like Knight and Frank and a couple others. So a broker would help you get a good seller. Now, once you have a seller and you've kind of agreed on all terms and conditions of your sale, etc., then it's advisable to get a lawyer or a solicitor on the scene who will draft out your sale deed for you, and also maybe undertake a background check to make sure that the seller is genuine. I mean, the purchaser is a genuine purchaser and you're not going to face any litigation down the line. Once all your documents and everything are ready, that's when you go ahead and execute the deal. And over there, then the sale deed will have to be registered. So depending upon where the immovable property is situated in, you approach the stamp office of that area, that region, and you get the sale deed registered, pay stamp duty thereon. And of course, then there are even capital gains tax liability, which we have talked about earlier, which has to be factored in. And you have the options of investing in specified assets and not paying tax thereon. So these are some of the things which will come into play.
Got it. Rahul, this question would be to you. This is a question about trusts set up in India. How would you go about taxing, or I guess considering the taxability of trusts that are named in the name of grandkids, and how would you treat that in the U.S. for taxation purposes?
Sure. So foreign trusts with U.S. beneficiaries are subject to an extra layer of rules and complexities that you need to manage. The most important thing to understand is whether it's a fixed income trust, meaning the beneficiaries get a certain fixed amount per year, or if it's a discretionary trust where the trustee has the discretion to distribute some income, all income, no income, in their discretion. And if they don't distribute all of the income and they accumulate it over the years, then you have to be worried about what's called the accumulation distribution rules and the interest surcharge that goes with that, which can be very punitive. So, you definitely want to look at the character and the source of the income that's being generated by the trust. and how it's being managed on a year-to-year basis. Generally, you're going to want to try to get what's called DNI, distributable net income, out to the U.S. beneficiaries during the year so you prevent large accumulations. But obviously each trust and each family has different circumstances, and sometimes you may not be able to do that, in which case then you want to do some long-range forecasting to figure out how much or how little should be accumulated in order to minimize the negative consequences of the accumulation distribution tax and the interest surcharge.
Perfect. This next question is to Vinay. Vinay, I think you had actually answered this question, but the question seeks a little bit more of a clarification. The question asks, there was a mention of green card holder not having to file the U.S. tax returns. So they want you to, just address that one more time. And also, is it as easy as making an option at the time of becoming a green card holder?
So it's not as simple as that. General rule is, as a green card holder, your taxes are as a U.S. citizen on your worldwide income, just like anybody else. For a green card holder who's actually living in India, there is a set of rules known as the tiebreaker rules under the U.S.-India tax treaty that tries to define whether you're a U.S. resident or a Indian resident. So if by going down those rules, generally speaking, if your true domicile, your true home is India, you're an Indian citizen, but you happen to have a U.S. green card, then under the U.S.-India tax treaty, you would be considered a Indian resident, not a U.S. resident. But that's the tax answer. It kind of brings into now you have to look at the immigration side and say, okay, if I'm really meeting the tax definition of being an Indian resident, am I fulfilling my green card requirements? And I'm not an expert on that, but you could find yourself getting the right tax answer but getting the wrong immigration answer on that. So it's something to really, you have to work through and think about carefully.
Right. And the next question asks, is the $2 million exit tax, is it per person or per family? And then I'll stay with you.
Let me defer that to Rahul because he's got more experience in that area.
Okay, Rahul?
That is per person.
Per person, okay. And we had a sort of like a fact pattern that came through as a question. Suppose we have two U.S. citizens who have been living in India for many years. And over the years, they've made few short trips to the U.S. to visit relatives and friends. These two people, let's call them Sachin and Rahul. Sachin has an interest-earning personal bank account in California. Rahul owns an apartment in California from which he's getting rental income. Each files a U.S. federal tax return on his worldwide income, and then an Indian tax return on his worldwide income, where a foreign tax credit has been taken for the U.S. earned income. So the first question is, do Sachin and Rahul need to file a non-resident California tax return for this income? And Vinay, I'm going to address that question to you.
So the one person who's got the rental real estate clearly has to file a California non-resident return, and that's pretty much going to be the answer in almost every state. Income from real estate is sourced to that state, and pretty much any state is going to say, yes, you need to file a non-resident return to reflect that income in that state. California, we believe, takes the same position on interest income, on bank accounts and things like that, but I would tell you that's probably not the norm in the U.S. Most other states would say that if you just simply have a financial type account, you're not going to be subject to that state's income tax.
Got it. And the next question is to Rahul. Rahul, what kind of investments could they make to ensure that they're not subject to state tax?
So the answer here is not so much what type of investments in terms of bank accounts, stocks, or whatever. I mean, clearly real estate, we know the answer, right? If you don't want to get taxed in Wyoming, don't own Wyoming real estate. But in terms of passive, portfolio assets, stocks, bonds, bank accounts, etc. There it's more, as Vinay mentioned, very state specific. So California has a rule which says that if your account is with, let's just pick on Merrill Lynch, with a Merrill Lynch brokerage, and that your broker is in an office in LA, tough luck, you get taxed as that's California source income. And that seems odd because then the solution is, well, I'm just going to change my broker to someone in Florida. And I'm going to take the investment, I'm going to take my account to outside of California to a different state. So, it's a very state-specific answer. A lot of states will say that, yeah, fine, you can have portfolio assets and you can have the account in our state. We won't tax it because you're a non-resident. But we have these few peculiar states like California, which will tax it. So it's really not so much about the type of investment, ignoring real estate, obviously, but more about the location of the investment. Where is the fiduciary, the financial institution, which is managing the account for you?
Got it. So now I'm going to move on to the questions from today. The first question asks, if I sell a plot of land in India and I buy an apartment in India, will I get a capital gains tax refund in India? And then will I still pay capital gains tax in the US? So I guess the first part of this question is to Rupal.
There's no question of capital gains tax refund over here. What happens is when you sell your land, you will compute your capital gains. That gains you will invest in your residential property, and there will be no tax liability on the capital gains because you have invested in the residential property. So there is no question of refund, but there will be no tax liability either. And for the US, I'll refer it to Vinay.
Yeah, Vinay, you want to handle that one?
And the US answer is easy. Yes, there will be a capital gains tax. It's completely independent of the Indian rules.
Okay. And then the next question is, what is the U.S. tax liability of sale consideration on shares sold by Hardeep? So I'm going to move back to that fact pattern, just so that people have it here. So the question asks again, what is the U.S. tax liability of sale consideration on shares sold by Hardeep? Also, are these shares liable to estate duty in the U.S.? So I think the first part of it, Rahul, do you want to take that one?
Sure. Well, yeah, it's clear. Hardeep, being a U.S. taxpayer, has sold a capital asset, and so he will be subject to capital gains tax. And on the estate question, well, estate duty only applies when you die. So here he sold the asset. He's still alive. Now, once he sold the asset and he now has cash in his hands, if he were to die tomorrow, that cash, yes, could be subject to U.S. estate tax if he's over the lifetime exclusion amount, the $5.45 million.
Right. And the next question is still based on this fact pattern. What happens in the U.S. on inheritance by Hardeep of the 90% shares in the textile company held by Hardeep's father? I think you addressed that, Rahul, but if you wanted to do it again.
Sure. Well, upon the inheritance, we have to take a look first at what's the value of the inheritance. If the 90% stock in the company, if that's over $100,000, then Hardeep has to file Form 3520 to report that foreign inheritance, and then at that point, the stock becomes part of his gross estate for future estate planning purposes and future estate tax purposes if he dies owning that stock.
Got it. And then this next question says, green card holder with rental income in India, can they claim depreciation from the date of becoming a green card holder? In India, the depreciation is not deducted from the rental income. So I'm thinking this question is to Vinay.
Yeah, so here's how I look at it. When, let's say somebody's in India, no U.S. connection, has rental property, they're abiding by the Indian rules on taxation, then they come to the U.S., whether it be on a green card, H-1, whatever. When they start becoming subject to U.S. taxation, now the profit and loss of that rental activity will appear on their U.S. tax return, and they will be eligible to claim depreciation based on U.S. rules with respect to that asset. So if they are place the asset in service in 2015 and move to the U.S. and become subject to U.S. taxation in 2017, they will basically be claiming year 2 out of year 40, which is the depreciable life of real property outside the U.S., on their 2017 U.S. return. So they will start claiming depreciation for that asset, regardless of what the Indian rules say about depreciation.
Got it. And this next question is part of the previous question. Depreciated rental property, what is the value when it is inherited by sons and daughters in the U.S.? Not so sure if you need more to that question, but
yeah. Well, effectively, it's like just because the property is being rented doesn't change the overall principle that Rahul talked about a second ago, that when the person receives it, we look at the value, the true fair market value on that day, and that becomes the cost basis to the recipients.
Right. And the inheritance is always afforded the stepped-up basis benefit, right? So in that case,
Correct.
At least there's no capital gains when it's inherited by the sons and daughters.
Correct.
Okay, so that's all the time we have for your questions today. If you have others, you can always feel free to email it to us. I am just going to take a few seconds to put this up on our screen. These are our email addresses, so feel free to email any one of us if you have a specific question that you want addressed. Also, if there's anything else in terms of topics you want us to speak about, let us know so we can see if we can put together other webinars for you. We hope you enjoyed today's program, and we thank you again for joining us today. Good day and good night, everyone.